Ladies and gentlemen, good morning and welcome to the Happiest Minds Technologies Q2 FY21 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hardik Sangani from ICICI Securities. Thank you, and over to you, sir.
Thank you, Lizan. Good morning, ladies and gentlemen. Thank you for joining us today on Q1 FY21 earnings calls of Happiest Minds Technologies Limited on behalf of ICICI Securities. I would like to thank the management of Happiest Minds for giving us the opportunity to host this earnings call. Today we have with us Mr. Ashok Soota, Executive Chairman, Mr. Joseph Anantharaju, Vice Chairman, CEO of TS, Mr. Rajiv Shah, President and CEO of DBS, Mr. Ram Mohan, President and CEO of IMSS, Mr. Venkataraman, Managing Director and Chief Financial Officer, Mr. Aurobindo Nanda, President, Operations and Deputy CEO, PES, Mr. Sunil Gujjar, Associate Director. Now I will hand over the phone to Sunil for safe harbor statement and to take the proceedings forward. Thanks, and over to you, Sunil.
Thank you, Hardik. A very good morning to all. Welcome to this conference call to discuss the financial results for the second quarter ended September 30th, 2020. We trust all of you are keeping well and staying safe. I am Sunil from the Investor Relations team. Ashok and Venkat will begin the call with a brief overview of the company's quarter 2 performance, after which we will have the floor open for Q&A. Before I hand over, let me begin with the safe harbor statement. During the call, we could make forward-looking statements. These statements are considering the environment we see as of today and obviously carry a risk in terms of uncertainty, because of which the actual results could be different as outlined in the earnings release, which is available on our website. We do not undertake to update those statements periodically. Now, let me pass it on to Ashok. Over to you, Ashok.
Thank you, Sunil, and good morning, ladies and gentlemen. I'd like to welcome all of you to Happiest Minds' first investor conference subsequent to our IPO. I would like to thank all of you for your support and goodwill, which helped to make the IPO so successful. We are happy to place Happiest Minds results for the quarter before you. In brief, we have delivered on our pre-IPO promise that this year lower growth will be compensated by higher profitability. We had also cautioned that in view of so many market uncertainties, our quarter 1 EBITDA should not be annualized. However, I am happy to inform that in spite of our cautionary advice, we have been able to further improve on the Q1 EBITDA. You may have noticed that our press release reporting is very comprehensive. We have shown quarter over quarter, year over year, and year to date over year to date. While looking at our numbers, please keep in mind that there was a one-time deferred tax asset in quarter 1. Therefore, please look at the operational results for comparison rather than PAT. I'd also like to highlight, and I think this will be a feature of what you will see from us going ahead also, that our disclosures are more extensive than I would imagine almost any other company in our industry. We have given not only the vertical data, but we've also given how much of the business comes through different horizontal technologies, which really constitute the digital technologies. In addition to the top 5 and top 10 accounts, we've also given how much business comes through the top 20. Finally, we want to share with you that our board of directors has approved the appointment of Joseph Anantharaju as Executive Vice Chairman, and he now comes onto our board. Venkataraman, who is already on the board, is elevated to Managing Director and CFO. Both Joseph and Venkat have contributed enormously to Happiest Minds' success, and these appointments will further strengthen our governance. And with this, I'd like to hand you over to my colleague Venkat.
Thank you, Ashok. Good morning to all of you ladies and gentlemen. I would like to thank ICICI Securities for hosting this call. In the next few minutes, I'll attempt to give you an overview or a highlight of our financial results for the second quarter entered FY21. One, revenues in US terms, dollar terms, has shown a growth of 5.4% over Q1, while being relatively flat on a YOY basis. As you will recollect, during our IPO process, we had clearly communicated that given the COVID situation, we would only see a marginal revenue growth during the year, but make up for the same in a fair measure through improvements in profits. Now coming to profits, to give you a trend, we had EBITDA of about 16% in FY20. So that's what we ended FY20 with. We exited FY20 with an EBITDA of about 19% in Q4. That's Q4 of last year. Our focus and objective was to improve on this number through increased revenues and improved efficiencies on our SG&A spends. Then we came to Q1. We reported an EBITDA of 25.3%. As explained during our IPO roadshow and other conferences, this was higher than what we had internally forecasted, and the improvement was on account of benefits of working from home, a benign exchange rate, reduced travel and visa spends, reduction in rental, and the similar. Now coming to Q2, we have maintained and also improved on the EBITDA that I said about for Q1. Our EBITDA for Q2 was 26.3%. This was possible on account of increased revenues, improved utilization, lower attrition, and also the continued benefits that continue to accrue to us from exchange rate, working from home, reduced travel and visa costs, reduction in rentals, etc. Interestingly, our EBITDA levels are now closer to the larger Indian IT companies. Our Q2 PBT was at about rupees 42.7 crores and 22.7% of revenues, compared to rupees 39.44 crores and 21.2% in the previous quarter. I'm pulling out PBT separately because that gives you a feel of what the deferred tax asset creation in Q1 did to our PAT. However, when we come to PAT, as Ashok briefly alluded to, and as clearly disclosed in our financials, in Q1 we had a tax charge of about 8.5 crores and a one-time credit for deferred taxes of rupees 17.85 crores, leading to a net credit of 9.5 crores. Whereas in Q2, we did not have any such one-time credit, but only the normal provisions for taxes, leading to a drop in PAT on a comparative basis. Our balance sheet return ratios of ROCE and ROE continue to be healthy and good at 36.3%. We continue our very strong cash generation and ended the quarter with about 450 crores of cash on our books. This of course includes the 100 plus crores that we raised through the IPO. Ashok again alluded to this earlier. Keeping in with our principle of increased levels of disclosures, we have placed in the public domain our presentation to investors with detailed operational and financial metrics, which I hope you have had a chance to go through. With this, I would like to open up this session for Q&A.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hardik Sangani from ICICI Securities. Please go ahead.
Congratulations, sir, on your good result. So just a couple of questions. So firstly, how has been the deal traction?
Sorry to interrupt, Mr. Sangani. So we are not able to hear you clearly.
Now am I audible?
Much better. Thank you.
Yeah. Okay. Congratulations on a great set of results, sir. So a couple of questions. How has been the traction within the deal signings in current quarter in terms of value? So has it been up by QOQ, something like that? What are the current BUs within our business do we see which can accelerate our growth going forward at least in next couple of quarters? And what part of margins do we think is sustainable going for the next 2 quarters as well? That's from my
Joseph, you want to get started?
Yes.
Yeah, and then hand it to Venkat, I guess. Sure.
Yeah, so the margins and hand it to Venkat. Okay. In terms of our order book, it has increased sequentially by 8% in Q2, and if you look at the first half, on a year-on-year basis, we've had an increase of 11% in our order book. And again, our pipeline is at is around 20% higher than what it was in Q2 of last year. Venkat, do you want to take the margin question, Venkat?
Rick, I will have to request you to just repeat the margin question because the second part of the question was a little muffled.
Sure, sir. So just on the margins part, so our margins are quite up on a QOQ and a YOY basis as well. So just wanted to check. So as what part of the margins do we think we will be able to maintain forward as all the IT companies are giving hikes? There will be return on some travel cost in next couple of quarters. So what part of it is sustainable?
Oh, okay. What part of the margins that you are asking is sustainable? See, as we stand right now, we are almost in the middle of the first month of the third quarter. We will be continuing to work from home till the end of this year, and that's also being considered or evaluated for further extension. And so to that extent, travel restrictions will continue. The rental reductions that we have negotiated will hopefully continue. When it comes to the visa cost and relative reduction, that also will continue. And the exchange rate, as we see, given the current election scenario, we are also seeing a little bit of a slide in the rupee versus the dollar. So I think the aspects of the other aspects which added to our profits will continue through Q3. And on the operation side, I think again I see the continued operation stability and improvement, like I talked about in Q2.
Sure, sir. That's it for me.
Thank you. The next question is from the line of Jason Soans from Monarch Network Capital. Please go ahead.
So thanks for taking my question. My question was in regards to profitability. So in terms of, your 3 segments, IMSS, DBS and PES, this quarter we have seen some, if you, I'm referring to the EBIT segment. So even in terms of YOY, the revenue is fine, but YOY and QOQ profitability in all the 3 segments seems to have taken a sharp decline, actually. So just wanted to know, is there some element of seasonality in it, or is there some element of, a pandemic-related thing? Just wanted to understand, more about that and about the way going forward in terms of profitability.
Hi, Jason. Thanks. It's a very good question, and this comes out from the SEBI format financials, if I'm right. There, what's happened is that variation is on account of a slight bit of accounting change between Q1 and Q2, how foreign currency loss has been allocated. So in Q1, we had foreign currency gain being allocated, whereas in the second half or second quarter, we didn't have the allocation of foreign currency loss. So this is something to do with the way accounting is done. But to give you comfort, all the 3 segments have grown, like you have seen in the revenue numbers, and profitability have also improved. So it's a kind of a secular profit improvement across all 3 revenue segments. Obviously, we have slight differences between the 3 when you look at the gross margins, which are something that we track internally, and that's part of our entire portfolio of profit build up for the company.
Okay, thanks, sir. And just would want to know if you could provide some guidance for FY21 and 22, if possible. Just wanted to understand.
Hi, Jason. Again, we are not now giving guidance.
Right.
So to that extent, we'll limit ourselves to our Q1, Q2, and the past year's performance.
Okay. So and just my last question is, just wanted to understand, in terms of competitive landscape, you have peers like Globant, EPAM, which are pure play digital players, and also the behemoths like TCS. And so just wanted to understand in terms of competitive landscape, how are you seeing growth? I understand you're, the base is small in terms of Happiest Minds, and you're still scaling up in terms of your services. So just wanted to understand growth forward in terms of competitive landscape as well.
Venkat, I can just take one aspect and then maybe you could add to this. As we stated in our own pre-IPO presentations, that we actually see our two comparators as, in a sense, EPAM, Endeavor, and Globant, because they are the 100% digital companies, and we also were sustaining the sort of growth rates and profitability levels that they had. Their results, as you know, have not yet come out. We have no reason to believe that, we have rather reason to believe, looking at our own last 2 quarters, that we should be comparably on a good path. I don't want to make any comparisons with individual Indian companies. As you mentioned, we are competing against global giants and so on and so forth, because that data is already out in the public domain. And you would see, in a way, that all those numbers are very comparable. There may be one person who's better and maybe many others who are not. But Venkat, you may want to add to this part of the question.
Again, Jason, great question. This is taking off from where we left off during our IPO roadshows. We did compare our financial metrics versus the EEG companies, which is EPAM, Endeavor, and Globant. Our revenue growth has been comparable, but always I've been mentioning that they have a huge element of acquisitions coming in to add to their revenue growth, compared to almost 100% of our growth coming in on an organic basis. So that's for the first set of revenue comparisons. As far as profitability metrics are concerned, we are better than almost 2 out of the 3, and very close to the third one. Return and capital ratios, we are ahead of them significantly. So that's how we compare on the financials. But this is all with respect to what we have for the previous quarter of these companies and for which we have results.
Thanks. That's all from my side.
Thank you. We'll move on to the next question. That is from the line of Rishit from Nomura. Please go ahead.
Hi, thanks for taking my question. Congrats on a decent quarter. Just a couple of questions, right, from a demand side. Now, when we look at most of the comments, right, we've seen an accelerated shift to digital across the board, right? And given we are a born digital company, right? It should, from a demand perspective, it should have dramatically improved for us. In that light, TCV increase of roughly about 11% for the first half seems a little too low. Could you just help us understand the demand environment and how the discussions are changing with clients? That's one on the demand. Second, just an extension of it. Cloud seems to be more of a buzzword. But if you look at our growth in the cloud segment, I think it's been a little more tepid even in FY20 and going into 1Q, 2Q, FY21 as well. Could you just help us understand more, given our presence is pretty strong across the 2 large hyperscalers?
Sure. Let me just again take the first part on the overall demand, Venkat, then pass it over probably to you and even Ram on the cloud part of it, or Joseph for the other part. So, as you've seen in the past, we've always said that we expect to grow faster than Indian industry. And that's clearly borne out by our past numbers. We also did say that this year, you're going to find it difficult to be able to be those levels, but we will make up through improved profitability. And that is actually what has happened so far in the first 2 quarters. In this unusual environment, whereas, much of our business is not really impacted, but all of us got a reduction in Q1 because there were any initial cancellations or ramp downs or deferments. And that is already carrying forward in terms of reflecting cumulative year-over-year results. So I think we should wait and watch how this flows out in the rest of the year. But our overall statement will remain the same for this year, that we will make up through profitability any reduction in overall growth. If you just look at, in a sense, valuation as a combination of both of these, then I think those we will stick to what we've been promising. I don't know whether Joseph would like to take up the second part of the question.
Sure. So in terms of the industries, if you look at quarter two over quarter one, we've had growth in edutech, industrial manufacturing, and the media segment. But at the same time, from a opportunity angle, we're also seeing a fair bit of demand and need in retail, more from an e-commerce angle, and the high-tech vertical, which continues to do well. In terms of cloud, I just wanted to clarify, if you look at all the other areas that we've listed out, IoT, AI, all of them are being developed on the cloud. So most of our business, majority of our business comes on is on the cloud. So sometimes if you're doing an IoT implementation, it will still be on the cloud, but it would go into the IoT offering, and that's the reason why you may see a small decrease quarter on quarter, in the cloud percentage of the business. But I just want to reiterate that most of the work that we do for our customers, whether it's in IMSS, BBS, or PS, is on the cloud.
Okay. So essentially, then I would have thought that rather than making up from a profitability standpoint, would it make sense to invest aggressively, given digital is the more frontline area where demand is, and given that we don't have the baggage of legacy, does it make sense to sort of invest more rather than increasing margins? Because when I look at the other expenses, that's expanded by about 700 bits over the last 4 quarters, right? So that's one. And just if you could also explain the margin walk of those 700 bits in the other expenses and how much of that is sustainable.
Yeah, I'll just take this issue of investment. Firstly, I appreciate the nature of your response, and I think it's very important in the long term. But let me assure you that our investment continues. We are continuously expanding new offerings, new solutions, and so on. So none of that has slowed down. And we will continue to do so, and we will achieve whatever margin improvement you've seen in spite of that. And of course, favorable factors which led into that have already been given to you by Venkat. So Venkat, let me hand this over to you for the next part.
Yeah. Thanks, Ashok. So Rishad, there were 3 or 4 elements which significantly added to the margins. One is the increase in revenues, which we talked about 5.5% in dollar terms. We had improvement in utilization, a smart perk up, which also we have covered in the presentation and the press release. The third point was lower attrition. So you see, attrition cost is something that gets baked into your P&L, and when that is low, you have the benefits inuring into the bottom line. Exchange rate. So these are the 4 major things, and in addition to that, you had travel, which is I think the 3rd largest cost for any IT services company. That's almost kind of now to the bare minimum. Visa cost and travel costs, which have come down to the bare minimum. And then you had finally these one-time, I would not say one-time, these quarterly kind of credits that we are getting in terms of rental reductions, because we are taking it on a quarter-on-quarter basis. There has been reduction in rentals and also a lot of the related administrative costs. So all of this put together is what has helped us improve the margins, and the walkthrough is essentially split into many of these buckets.
Perfect. Thank you. Thank you so much.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Ravi Menon from Motilal Oswal AMC. Please go ahead.
That sounds good. I guess questions to you. Just
sorry to interrupt, Mr. Menon. We are not able to hear you.
Hello, is it any better?
Yeah, much better.
Thank you.
Thank you. So, Venkat, my questions to you, just wanted to get a sense of how much do you think we will need to add on in terms of travel costs and other, SG&A expenses once things normalize? I mean, perhaps it might even be a year from now. But whenever it does, Do you think it'll be just 100 basis points or so, or do you think it could be more?
Yeah. Ravi, again, we had during our earlier part of the roadshow and also before the Q1 results, we had mentioned that the improvement in profits that we would seek to achieve during the current year would primarily come from our efficiencies from SG&A cost. And I had also mentioned earlier that we would look to reduce that by 1.5% to 2%, because as the size of the company improves, we are well invested in our management and almost all of the fixed costs, and the capability of the team out here is to do a larger business. So to that extent, we were expecting the SG&A cost to come down. So the improvement from the 19% of last year, I said I exited Q4 with about 19%, was to add another couple of percentage points on account of this alone. Add to that were the benefits that we were to accrue because of the improved utilization and the revenue mix and the type of revenue that we would bring into the business. So if you look at it, these two are what I would say are sustainable. And after that, what we have gained in terms of travel, what I'm told is the travel expenses or travel is not likely to come back at the speed at which we all expect. It's going to take time. So that's going to come in. I think it will be on a tapered basis. So we'll see that increasing slowly over a period of time. As far as work from home is concerned, we are looking at it, evaluating the situation. So right now, the benefits are expected over Q3, maybe even longer, but that's something that's a decision that will be taken. And we are taking a kind of lower risk approach, waiting for the vaccine and all of that. So to that extent, we expect that benefit also to come in. So if you look at it, finally, the unknown piece is the exchange rate. I don't want to forecast our exchange rate. We follow a very careful or conservative exchange hedge mechanism to ensure that 50% of our foreign exchange inflows, net foreign exchange inflows over the next 12 months are covered to the extent of about 50%. So that's what we do. So I think you can add all of them, and you would come to a number which is a sustainable percentage.
All right.
Thank you. We'll move on to the next question. That is on the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Can you just help us understand outlook across the industries which we report? So we get some sense about, and if you can provide some better perspective, what exactly we do in each vertical and what is driving demand in those verticals to understand overall business. That is question one. Question two is about in our top 20 clients, any area of weakness where you think some of the clients we are facing some trouble, or you think now largely all top 20 likely to grow on ongoing basis? Thank you.
Sure. So, I'll just, I'll give what are the areas in some of the verticals that we are focused on that customers are coming back to us with demand or requirements. If you look at edutech, many of the use cases or verticals that we are seeing are verticals that have had a positive impact from the COVID situation. If you look at edutech, a lot of the work that you're doing is more around augmenting some of the remote and online learning features in the edutech platforms, helping them with more data collection and analytics so that they can help the students and the faculty better. Industrial and manufacturing, we did see a little bit of drop off in Q1, but in Q2, what we're seeing is that customers are looking at more of initiatives around digitization, around supporting their field support in a remote manner, e-commerce where applicable. In terms of media, we're seeing customers more around digital media, which can be consumed because that's something that's happening with people being more at home. In terms of retail, a lot of focus is around e-commerce and analytics to support things like personalization and recommendation And some of the interest that we've had in the BFSI segment has been around more of the customer experience, improving it and making it more intuitive. High-tech continues to do well because the spend hasn't flagged off over there. Revenues have stayed steady, and so they continue to invest and build. So that's on in terms of what we are seeing right now in some of the verticals that we are focused on. In terms of our top 20 customers, right now we don't all of them are going through their budgeting process right now, but we don't see any major issues in many of them. They all are being quite cautious in the way they're approaching their spend, and in terms of any new initiatives, they're taking a more deliberate approach where they do a quick MVP, try to figure out that's something that's working with their customers instead of committing to very large projects and programs. They're doing it in a more phased manner. Yeah.
Joseph, there was also a second part of the question. Are you seeing any risks on the top 20 accounts?
That's what I answered, right? So.
Venkat, I think he answered that. He really said that there's no crisis or anything in them, and they're doing a measured growth as they go along.
Sure.
Yeah.
Should we move on to the next question?
Yeah, please do.
Thank you. We'll move on to the next question that is from the line of Hasmukh Visaria from FUD Life. Please go ahead.
Yeah. Hi. Thanks for giving me the opportunity. So I have one question around our digital service offerings. So if I look at the service offerings in our security solution specifically, so the basically percentage of revenue of security solutions have declined by almost 14.9% in FY20 to now 7.4. So what just wanted to understand what's happening there. Is there any loss of customer or just shuffling from one segment to the other?
Sure. Ram?
So can you hear me?
Yes.
Because there was a problem and people were not able to. Oh, okay. So there is what we are seeing is there is a generic upgrade in the security, but last year some of the projects got closed because many of the security projects runs for some time and get closed. But now we are seeing an uptick from last quarter to this quarter. From the security services perspective, we are seeing some uptick. But what has happened is some of the projects where other segments also participate in terms of security testing, and some of the projects have got over, and that's why you are seeing a reduction. But we are confident that as we move along, the security projects will continue to grow.
Okay. Thank you very much. That's it from my side.
Thank you. The next question is from the line of Rishit from Nomura. Please go ahead.
Hi, thanks for giving me the opportunity again. Just one last broader question, right? What are the key areas of investments that we will be looking to make, which will drive us from the 100 million to a more, let's say, a 300 to 500 million dollar company, right? And it could be in terms of additional sales, it could be in terms of additional technologies. What are the key bets that we're making sort of right now? If you can just provide a little more color, it will be helpful. Thank you.
Sure. I could get, again, Joseph probably give you a better response, except I want to highlight one thing, that if you look at our technology and solutions coverages, you'll find that they're really very robust, in the sense that we are literally state-of-the-art in any new area which comes in. And actually, a lot of people say, how could a company of your size continue to be in so many areas, and we invest in them? One good example could be blockchain. We got into it where we say, hey, how come you're doing it? We already have 3 orders there. We got into drones, we've got a second order there. So that process in the technologies where we are will continue, and I think we've actually already mapped onto all that is really relevant in terms of major growth segments. If you see, in addition to what I told you, we were already there in IoT, we're in virtual and augmented reality, we're into robotics in addition to drones. So we really have a broad presence. However, I will give you one indication, and as you know, we also generate a lot of IPs. We will be looking to see how we marry our horizontal technologies with our domain capabilities. I think that will lead us into a next generation of investments. It's not that we don't do that even now. We have, for example, an IP in the edutech space, which Joseph can talk about. But Joseph, you can take over from me in terms of the response to that question.
Sure. Thanks, Ashok. So I think a few strategies that, as a management team that we put together, and this is, evolving list. As and when you see opportunities, we will relook at them. Some of the things that we're looking at which will really help us to acquire new business and growth. The first one, I think, is around building deeper vertical capabilities, and that's something that we're looking at right now. We do have some vertical and domain capabilities, but we feel that we will have to get deeper so that we get involved a little bit more upstream. And related to that is beefing up some of our consulting capabilities. The second one is around account mining. We have instituted a process of account development plans, which are very deliberate. And there are reviews that take place at regular intervals. But we've started some of these processes as we discussed in the a couple of months back, and we're making sure that they get disseminated and they're followed in a very disciplined manner. This should lead to more account mining and getting a higher share of customer wallet. Cross-selling is another thing that we're putting a lot of focus on. Right now, we have 42% of our revenues that come from cross-BU, and we will continue looking at how to increase that number so that we get a higher share of wallet from customers. Now, our percentage of on-site is on the lower side, and we'll be looking at how do we increase that so that we have more presence at the customer's location. It will also lead, apart from getting revenues, it will lead to a little bit more of intelligence. Ashok talked about technology, right? And I think it's very important for us to continue identifying the next set of digital technologies and keep building capability, just like how we identified drone and blockchain a couple of years back and started building capabilities, which is yielding results now. We will have to look at the next set of technology, and that's what our CTOs they're doing. They have a global CTO and CTOs in each of the businesses. Together they form the technology council, and that's their responsibility. Also on IP, I think as Ashok mentioned, we'll have to look at the horizontal or technology and cut off vertical and come up with more of sharp IP that will help us both penetrate and lead the services with it. The last point I wanted to make, as you grow, you will need to look at some acquisitions, and that's part of the strategy that we have as and when we find an appropriate candidate. We will do the evaluation and take the appropriate decision. So these are some of the things that we will need to do. The last one I wanted to just mention is we have to continue ensuring that we attract and build good talent and retain them. So that will be again very important in ensuring the whole thing around happiness and at GPTW. We've been in the top 100 for couple of years, 3 years running now. Our Glassdoor rating is 4.2. So all of these we believe will contribute to that journey from $100 million onwards going forward.
Fair enough. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Hardik Sangani from ICICI Securities. Please go ahead.
Hi, thank you for giving me the opportunity. Sir, just a couple of questions. So, primarily what we have increased our Fortune 2000 customers by 239. So what would be our particular strategy within those clients, and how do we see in terms of large deals, or how do we incentivize our sales team to actually go and get those kind of large? Thank
you. So, thanks, Hardik. I think it's a good question. So as I mentioned, one of the strategies for growth is going to be around account mining and account expansion. As we've taken, in many of our customers, a land and expand strategy where we get in with our digital and our digital offerings, help customers with some of their innovation or tougher problems, and then we've expanded. And so this sort of lends itself, the 3 additional customers that you see. And so we're going to be focused on account mining. We are in the process of instituting, for some of our large accounts, more of account management or client partnership model. There's increased, collaboration that these account managers are doing between the 3 businesses to increase the share of wallet. So this will be a huge focus area for us to see how, and then the account development plans are a means of understanding the customer better and coming up, the spend patterns, the competition in there, some of the trends in the customer, and then come up with an account strategy that then the whole, organization can support to expand.
Then last question. So in the press meet, you alluded that UK and Europe would be the next legs of growth. So what would be the particular areas at which we would like to focus on in near term? And do we see to our effort mix ratio going up in coming quarters as we try to ramp up our more revenues at least next year onwards? And third question, do we so in generally all the IT companies have started giving hikes and variable pay. So do we plan to initiate the pay cycle like in near term?
So this is Rajiv. Thank you, Hardik, for this question. So as you have seen in our H1, we have seen growth in our Australia, New Zealand, as well as the European business, bringing our US percentage down. But US still continues to play a significant role for us. But the percentage of revenue as well as the contracts that we sign, we have seen a good traction in both of those markets. In addition, I think that we'll continue to follow our customers as we follow land and growth strategy with them as well. Just in terms of pure numbers, we signed about 8 new logos in this last quarter. And out of that, 2 of them came from Europe and 1 in Australia. So the significant portion of our new logo acquisition came from that market segment as well. So we'll continue to expand and invest in those geographies. At the same time, we'll continue to stay focused on our US market. And as a result, as of now, for our infrastructure business, we continue to see growth in the Middle Eastern market as well. Right? So Venkat, you want to take the variable pay question?
Sure.
Oh, Joseph, sorry.
Yeah, sure. And on the increment, when the COVID pandemic set in, this is in April, we had made a conscious decision to forego the increment cycle for July 2020. So what we have decided is that we will have the next increment cycle, which should have been in July 2021. We will do that in April 2021. At the same time, we are keeping a close watch on how things are evolving, and we constantly evaluate and have discussions. We'll take appropriate action or decisions based on how things evolve, Hardik.
And Joseph, it is worth mentioning that the variable pay has been going up very significantly through the year.
Yes. So at that point we had also taken a decision to reduce the variable pay. But what we've done now is starting with Q2, we've increased the variable pay and we've given people a path to get to 100%. So that's the other thing that we've already taken as a decision. Thanks, Ashok.
Yeah, thank you. That's it.
Thank you. We'll move on to the next question. That is from the line of Meenal Vivek Bodas, a shareholder. Please go ahead.
Thanks for giving me an opportunity. I have got one question based on the business mix. Which company has 80% time and material and 20% on fixed price? I have got two questions. One is time and material is not a long time commitment from the client side, and fixed price is a sort of a long time commitment from client side. I would like to know from your side what is going to be the trend and how this mix is going to be moving forward, whether there is going to be reduction in time and material or increase in fixed price projects, and what is going to be an impact of this on profitability.
Yeah. Good morning. This is Venkat. We have had almost a kind of a secular trend on the mix between fixed price and time and material. So there are a few points that I would like to say. This is essentially contract and billing structure between fixed price and time and material. Earlier in the call, we also said that we do comparisons between ourselves and the other EEG companies. We have looked at their billing or their contract structure and profile, and they are also similar to 80/20. Second is we are working in an area where we have to work very closely and collaboratively with our customers to evolve on the technology or the solution that needs to be placed. So to that extent, it's not as clear and fixed like in a legacy project where you could get into a fixed price project. So what ends up happening is you have to work collaboratively. You break down a very large project into multiple pieces or modules, and then we also have the agile way of delivering this work to them. So it's broken into very small logical pieces, and that's where the time and material and FP approach comes in. So I wouldn't draw more or I wouldn't read more than that into this ratio.
Venkat, and Mr. Poddar has a very genuine concern looking at what's happening in the rest of the industry, where he feels that T&M may not have a lock-in and therefore could be at risk. I think we can bring in Nanda here to explain, Nanda, that in our T&M, what is the continuity that we have with the customers, where actually those customers have now been with us for many years. So Nanda, can we get some color on that response from your side, from an operational side?
Yeah, thanks, Ashok. Am I audible?
Yeah.
All right. So like Joseph was explaining the model in which we work, Venkat was explaining the model in which we work is working in collaboration with customer, building their new platforms and products in most of the cases. Now, the reason why this contract is structured in a T&M model rather than a fixed price or any other model is most of the time when we are working on creating a new platform, the requirements are not known upfront and they evolve as we progress through the journey of building this platform. So we work very, very collaboratively, starting from a kind of a consulting environment wherein we work with the customers to evolve their requirements, define their architecture or design, and then kind of take into the engineering side and then finally taking it to the customer. In such an environment where the requirements are not very clearly known, the only way you can structure it is the financial part is in a T&M model. And this, if you really look at it, the kind of repeat business that we have from our customers kind of also tells us that model is working on fine for us because the repeat business is pretty high so far from what we have seen.
Thanks.
Thank you. We'll move on to the next question. That is on the line of Jason Soans from Monarch Network Capital. Please go ahead.
Sure, sir. Thanks for the follow-up. So just wanted to know, I can see that EduTech has over the years, the revenue contribution from EduTech is increasing, especially post-pandemic, which is which is justifiable. Just wanted to, know and if you could elaborate more on the potential of edutech as a sector, as well as more color on what you exactly do in the high-tech space and its potential as well if possible.
Sure. So if you look at the edutech space, as you rightly pointed out, especially in the pandemic scenario, the requirements and the demand in the industry itself has gone up. Though the overall spend of the edutech segment is much smaller, but for us it's larger because we built depth in that area. And we've one of our initial customers was in the higher ed space, and we built on top of it, and therefore we have a good, highest portion of our revenues coming from edutech. Now, apart from just the COVID pandemic, there's a larger couple of larger trends that are happening which give opportunity for technology. The first is, over the last 5-6 years, a lot of the education has moved from your typical books and paper-based education to initially online and now digital. And by digital, I mean where you have your courses being delivered from the cloud. You use a mobile or a tablet. And the second thing is this huge data element coming in, where you're, whether it's an assessment or in trying to figure out, do some kind of a predictive analytics to know, which way a student would learn, and then do some corrective action. So there's a huge element of data also coming in over there. So these are some of the things that I think are going to continue, creating demand from edutech standpoint. In high tech, we have 2 or 3, verticals that 2 or 3 areas that we classify in the high tech. One is all the SaaS or enterprise software companies that we work with. They've been classified under high tech. Also, our networking and storage, the companies in this space, we have them under high tech. Now, if you look at the SaaS companies, there's a huge demand for SaaS, so they continue to invest and add things like analytics and automation that is required. They're a little bit on the leading edge in implementing some of the newer technologies. In terms of networking, it's been up till now it's been more around the software-defined networking, network function virtualization. We're seeing 5G coming up now, which will also provide a need for some of these companies to upgrade their products. So that's the second area. We do have 1 or 2 telecom customers that are also classified under high tech right now. This is what constitutes high tech for Happiest Minds.
Sure. Thanks. That's all from my side.
Thank you. Reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Mithun Aswath from Kiva Advisors. Please go ahead.
Hi. My question was more in terms of the business growth. Do you see the pandemic becoming a bigger issue for companies which are smaller in size in order to get new clients, because your interactions are limited and it's difficult to travel? So just wanted your thoughts on that, on how you are doing marketing and trying to get new business during these times.
Yes, so this is Rajiv Shah, the head of digital business. Customers are still cautious with COVID, still not under control, and they have in the past have relied on high-tech, in-person business model, etc. But as a result, I think they continue to look at the digital business in a much more aggressive manner because of the alternative business model that they need to get into. Our approach to the market, as Joseph highlighted, constitutes various facets. Right? So we have a well-defined account management plan where we have a dedicated set of account managers to really understand and work with the customers to look at the digital strategy and become part of the larger program. We have our own inside sales teams which continue to generate leads, and that has resulted us into acquiring 8 new logos over the last 1 quarter as well. Given that we continue to invest in the disruptive technologies, which also plays a significant role in us working with the customers to put together proof of concepts to consultative engagement. So I think that we, while there is a curve on travel, there is still cautiousness on COVID. I think that we continue to interact with the customers to work with them in driving the digital adaptation in their environment.
Sure. If I might just add to that question, because it was preceded by a comment saying that our smaller companies are at a disadvantage in this time, and I'd like to assure you that it has nothing to do with size. In fact, it may be an advantage to be smaller and more nimble.
Okay, thanks.
Thank you. Ladies and gentlemen, due to time constraint, that was our last question. I now hand the conference over to Mr. Sunil Gujjar for his closing comments.
Thank you for joining us today. We look forward to interacting with you in the coming days. You can reach out to us on ir@happiestminds.com for any questions that you might have. Stay safe and healthy. Bye-bye.
Thank you.
Thanks. Thank you.
Thank you, everybody.
Thank you, everybody.
Thank you. Thank you.
Thank you and happy Diwali to all of you.